All right, reading 39, Portfolio Risk and Return, part 1 of Portfolio Risk and Return. Learning outcomes, the candidate should be able to calculate and interpret major return measurements, describe their appropriate uses, describe characteristics of the major asset classes that investors consider in forming portfolios, calculate and interpret the mean variance and covariance or correlation of asset returns based on historical data, explain risk version and its implication for portfolio selection, calculate and interpret portfolio standard deviation, describe the effects on portfolio's risk of investing in assets that are less than perfectly correlated, describe and interpret the minimum variance and efficient frontiers of risky assets and the global minimum variance portfolio, explain the selection of an optimal portfolio given an investor's utility and the capital's allocation line. Introduction. Construction of an optimal portfolio is an important objective for an investor. In this reading, we'll explore the process of examining the risk and return characteristics of individual assets, creating all possible portfolios, selecting the most efficient portfolios, and ultimately choosing the optimal portfolio tailored to the individual in question. During the process of constructing the optimal portfolio, several factors and investment characteristics are considered. The most important of these factors and risks and returns of the individual assets under consideration among individual assets alone with risk and return are important determinants of portfolio risk. Creating a portfolio for an investor requires an understanding of the risk profile of the investor. Although we will not discuss the process of determining risk aversion for individual or institutional investors, it is necessary to obtain such information for making an informed decision. In this reading, we'll explain the broad types of investors and how their risk-return preference can be formalized to select an optimal portfolio for among the infinite portfolios contained in the investment opportunity set. The reading is organized as follows. Section 2 discusses the investment characteristics of assets. In particular, we show the various types of returns and risks, their computation, and their applicability to the selection of appropriate assets for inclusion in the portfolio. Section 3 discusses risk aversion and how difference curves within corporate individuals' preferences can be constructed. The difference curves provides understanding and computation of portfolio risks, the role of correlation and diversification of portfolio risk are examined in detail. Section 5 begins with the risk assets available to investors and constructs a large number of risky portfolios and illustrates the process of narrowing the choices to an efficient set of risky portfolios before identifying the optimal risky portfolio. The risky portfolio is combined with investors' risk preferences to generate the optimal risk portfolio. A summary concludes this reading. Investment characteristics of assets. Financial assets are generally defined by the risk and return characteristics. Comparisons along these two dimensions simplifies the process of selecting from millions of assets that makes financial assets subsuitable. These characteristics distinguish financial assets from physical assets, which can be defined among multiple dimensions. For example, wine is characterized by its grapes, aroma, sweetness, and alcohol content, and age, among other factors. The price of a television depends on the picture quality, manufacturer, screen size, number of quality of speakers, and so on. Note none of which are similar to the characteristics of wine. Therein lies the biggest difference between financial and physical assets. Although financial assets are generally claims on their commonality across two dimensions, risk and return, simplifies the issues on real estate. The commonality across two dimensions, risk and return, simplifies the issue and makes them easier to value the real estate. In this section, we will compute, evaluate, and compare various measures of returns and risk. Returns. The financial asset normally generates two types of returns for investors. First, they may provide a periodic income through cash dividends or interest payments. Second, the price of financial asset can increase or decrease, leading to capital gains or loss. Certain financial assets, through design or choice, provide a return through only one of these mechanisms. For example, investors in non-dividend paying stocks such as Google or Baidu obtains their returns from capital appreciation only. Similarly, you can also own or have a claim in assets that generate a periodic income. For example, defined benefit pension plans, retirement annuities, and reverse mortgages make income payments as long as you live. You should be aware that returns reported for stocks indexes are sometimes misleading because most index levels only capture price appreciation and do not adjust for cash dividends unless the stock is labeled as total returns or net dividend reinvested. For example, as reported by Yahoo Finance, the S&P 500 U.S. stocks was 903 the 31st of December 2008. Similarly, Yahoo Finance reported that the index closed on 30th of January 2002 at 902, implying that the return of a close to 0% over the approximately 6.5 year period. The results is very different. However, if the total returns of S&P 500 are considered, the index would be 1,238.83. So yeah. In the following subsections, we consider various types of returns, their computation, and their applications. Holding period returns. Returns can be measured over a single period or over multiple periods. Single period returns are straightforward because there is only one way to calculate them. Multiple period returns, however, can be calculated in various ways, and it is important to be aware of these differences to avoid confusion. A holding period return is the return earned from holding an asset for a single specified time. The period may be 1 day, 1 week, 1 month, 5 years, or any specified time. If the asset, bond, stock, etc. is bought now, time minus 0 at the price of 100, is sold later, say at T. Okay. In the above expression, P is the price and D is the dividend. The subscript indicates the time of the price of or dividend. T minus 0 at the beginning of the period, and T is the end of the period. The following two observations are important. We computed a capital gain of 5% and a dividend yield of 2%. In the above example, for each of illustrations, we assume that a dividend is paid at a dividend is paid at time. If the dividend was received any time before T, our holding period returns would have been higher because we would have earned return by putting the dividends in the banks for a remainder of the period. Returns can be expressed in decimals. 0.07 or fraction of 7 out of 100, or is a percentage of 7%. The holding period return can be computed for a period longer than 1 year. For example, you may need to compute a 3-year holding period return from 3 annual returns. In this case, the holding period return is computed by compounding the 3 annual returns and the 3 annual returns. In this and succeeding parts, Of Section 2.1, we consider the aggregation of several single period returns. Arithmetic and mean return the asset have returned for multiple period holdings. It is necessary to aggregate these returns into one overall return for ease of comparisons and understanding. And it's also possible to compute the return for a long or an unusual holding period, such as returns, however, may be difficult to interpret. For example, a return of 455% earned by AstraZeneca PLC over the last 16 years may not be meaningful unless all other returns are computed for the same period. Therefore, most holding periods return are reported as daily, monthly, or annual returns. Aggregating returns across several holding periods becomes a challenge that can lead to different conclusions depending on the method of aggregation. The remainder of this section is designed to present various ways to computing average returns as well as discussing their applicability. The simplest way to compute the return is to take the simple average of all holding period returns. Thus, during annual returns of negative 50%, 35%, and 27%. We give this average as a 4% year. The arithmetic return is easy to compute and is known as the statistical properties as such as standard deviation. We can calculate the arithmetic returns and its standard deviation to determine how dispersed the observations are around the mean, or if the mean returns is statistically different from 0. In general, arithmetic or mean return is denoted by R bar and given by the following equations of assets I, where RIT is returns in period T, and IT and big T, and the number of periods are as such. Geometric mean return. The arithmetic mean return is the average of the returns earned on a unit of investment at the beginning of each holding period. It assumes that the amount invested at the beginning of each period is the same, similar to the concept of calculating simple interest. However, because the base amount changes each year, a holding or geometric period return may be quite different from the returns implied by the arithmetic return. The geometric mean return assumes that the investment amount is not reset at the beginning of each year and in effect accounts for the compounding of returns. Basically, the geometric mean reflects a buy and hold strategy, whereas an arithmetic reflects a constant dollar investment at the beginning of each time period. A geometric mean return provides a more accurate representation of the growth in portfolio value over a given time period and does an arithmetic mean return in general. The geometric mean returns is denoted as RGI and given by the following equation: the asset of I, where RIT is the return on the time on the period of T, and T is the number of periods. In this example, section 2.1.2, we calculated the arithmetic mean to be 4%. Exhibit 1 shows the actual return for each year and the actual amount at each end of the year. Using actual returns, beginning with the initial investment of €1, we have such an amount at the end of the 3-year period as shown in the third column. Note that we compounded the returns because unless otherwise stated, we receive returns on the amount at the end of the prior year. That is, we will receive a return of 35% in the second year of the amount of the end of the first year, which is only which is only €0.5, not the initial amount of €1. Let us compare the actual amount at the end of the 3 years of such an amount with the amount we get by using the annual arithmetic mean return of 4% calculated above. So this shows the difference in the mean calculated by arithmetic and the results calculated by the geometric calculations. For example, and using the above formula, the geometric mean return per year is negative 5% compared to the arithmetic mean return of 4%. The last column of Exhibit 1 shows that using the geometric return of negative 5% generates a value of such an amount at the end of 3 years, which is very close to the actual value of such an amount. Money-weighted returns or internal rates of returns. The above return computation does not account for the amounts of money invested in different periods. It matters to an investor how much money was invested in each of the 3 years. If she had invested 10,000 in the first year, 1,000 in the second year, and 1,000 in the third year, then had a return of negative 50% in the first year, significantly hurts her. On the other hand, if she had invested only $100 in the first 100 euros in the first year, in effect, 50% downturn is dramatically reduced. The money-weighted return accounts for the money invested and provides the investor with information on the return she earns on her actual investment. The money-weighted return is its calculation are similar to the internal rate of return and the yield to maturity, just like the internal rate of return. Amounts invested are cash outflows from the investor's perspective, and amounts returned are withdrawn by the investors, or the money that remains at the end of the investment cycle is a cash inflow for the investor. The money-weighted return can be illustrated most effectively with an example. In this example, we use the actual returns from the previous example. Assume that the investor invests 100 euros in a mutual fund at the beginning of the first year, adds another 950 euros at the beginning of the second year, and withdraws 350 at the end of the second year. The cash flows are shown in Exhibit 2. The internal rate of return is the discount rate at which the sum of present values of these cash flows will equal 0. In general, the equations may be expressed as follows, where T is the number of periods, CFT is the cash flows at time T, and IRR is the internal rate of return or money-weighted rate of return. A cash flow can be positive or negative. A positive cash flow is an inflow where money flows to investors, whereas a negative cash flow is an outflow where money flows away from investors. We can compute the internal rate of return by using the above equations. The flows are expressed as follows, where each cash flows, inflows or outflows occurs at the end of each year. Thus, CFO refers to CF0 refers to the cash flows at the end of year 0 or beginning of year 1. Okay. Although the money-weighted return is an accurate measure of what the investor actually earned on the money invested, it is limited in its applicability to other situations. For example, it does not allow for return comparisons between different individuals or different investment opportunities. Two investors in the same mutual fund may have different money-weighted returns because they invested different amounts in different years. Comparison returns. The previous subsection has introduced a number of return measures. The following example illustrates the computation, comparisons, and applicability of each measure. Annualization returns. Annualized returns, the period during which a return is earned or computed, can vary, and often we have to analyze a return that we calculated for a period that is shorter or longer than 1 year. You might buy a short-term treasury bill with a maturity of 3 months, or you may take a position in the future contract that expires at the end of the next quarter. How can we compare these returns? In many cases, it is most convenient to analyze all available returns. Thus, daily, weekly, monthly, and quarterly returns are converted to the annual return. In addition, many formulas used for calculating certain values or prices may require all returns to and periods to be expressed as annualized rates of return. For example, the most common version of the Bank SCO's option pricing model requires annualized returns and periods to be in years. To analyze any return for a period shorter than 1 year, the return for the period must be computed by a number of the periods in a year. The monthly returns is compounded 12 times, weekly returns compounded 52 times, and quarterly returns compounded 4 times. Daily returns are normally compounded 365 times. For an uncommon number of days, we compute the ratio of 365 to the number of days. Okay, so here's the use of other major return measurements and their applications. The statistical measure of returns discussed in the previous sections are generally applicable across a wide range of assets and their time periods. Special assets, however, such as mutual funds and other considerations, such as taxes and inflation, may require return measures to be specific to a particular application. Although it is not possible to consider all types of special applications, we will discuss the effects of fees, taxes, inflation, and leverage. Many investors use mutual funds or other external entities for investors. In the case of funds, charges and managers fees and expenses to the investors. Consequently, gross and net to fund expense returns should be considered. Of course, an investor may be interested in the net of expense after tax real return, which is in fact what the investor truly receives. We consider the additional return measures in the following section. Gross and net returns. A gross return is a return earned by an asset manager prior to deductions of management expenses, custodial fees, taxes, and other expenses that do not directly relate to the generation of returns, but rather related to the management and administration of an investment. These expenses do not deduct from the gross return because they may vary with the amount of assets under management, or may vary because of tax status of the investor. Trading expenses, however, such as commissions, and accounted for, i.e. deducted from the computation of gross returns because trading expense contributed directly to the returns earned by the manager. Thus, gross returns is an appropriate measure of evaluating and comparing the investment skills and asset managers because it does not include any fees related to the management and administration of an investment. Net returns is a measure of what the investment vehicle, mutual fund, etc. has earned for the investors. Net return accounts for all managerial and administrative expenses that reduces the investor's return because individual investors are most concerned about the net return. Some mutual funds will limit amounts of assets under management are at a disadvantage compared to the large funds that can spread their largely fixed administrative expenses over a larger asset base. As a result, many small-sized mutual funds waive parts of the expenses to keep the funds competitive. Pre-tax and after-tax nominal returns, all returns measures discussed previously are pre-tax nominal returns. That is, no adjustments have been made for taxes or inflation. In general, all returns are pre-tax nominal returns unless they are otherwise designated. Investors are concerned about the tax liabilities of their returns because taxes reduce the actual return of that they receive. The two types of returns, capital gains and income, are usually taxed differently. Capital gains comes in two forms: short-term capital gains and long-term capital gains. Long-term capital gains typically receives preferential tax treatments in a number of countries. Interest income is taxed on ordinary income. In most countries, dividend income may be taxed as ordinary income, may have a lower tax rate, but or may be exempt for taxes, depending on your country and the type of investor. The after-tax nominal return is computed as the total return minus any allowance for taxes on realized gains. Because taxes are paid on realized capital gains and income, the investment manager can minimize the tax liability by selecting appropriate securities and reducing trading turnover. Therefore, many investors evaluate investment managers based on after-tax nominal returns. The real return, so that's just how you calculate a real return. The leverage return, variance and covariance of returns. Having discussed the various kinds of returns in considerable detail, we now turn to measures of riskiness of those returns. Just like returns, there are various kinds of risk. For now, we will consider the total risk of an asset or portfolio of an asset as measured by its standard deviation, which is the square root of variance. Variance of a single asset. Variance or risk is a measure of the volatility of the dispersion of returns. The variance is measured as the average squared deviation of the mean. Higher variance suggests less predictable returns and therefore more risky investments. The variance or standard deviation squared of asset returns is given by the following equation, where RT is the return for a period T. T is the total number of periods, and mu is the mean of T returns. Assuming T is the population of returns, if only a sample of returns is available instead of the population returns, then the above expression underestimates the variance. The correction of simple variance is made by replacing the denominator with T minus 1 as shown next, where R bar is the mean return of the sample observations and S squared is the sample variance. Standard deviation of an asset. The standard deviation of a return of an asset is the square root of the variance of returns. The population standard deviation or standard. It's the sample standard deviation. S is shown below. Standard deviation is another measure of the risk of an asset, which may also be referred to as its volatility. And in a later section, we will decompose the risk measure into the separate components. Variance of a portfolio or assets. Let me drink my apple juice. Like a portfolio's return, we could calculate a portfolio's variance. When computing the variance of portfolio returns, the standard statistical methodology can be used by finding the variance of the full expression of portfolio return, although the return of a portfolio is simply a weighted average of the returns of each security. This is not the case with the standard deviation of a portfolio. Variance can be expressed more generally for n securities in a portfolio using the notation from section 2.1.7 of just reading. The right side of this equation is the variance of the weighted average return of individual securities. Weights is a constant, but the returns are variables whose variance is shown by VAR or variance of RI. We can rewrite the equation as shown next because the covariance of an asset will itself is the variance of the asset. We could separate the variance from the covariance in the second equation. The standard deviation of the two asset portfolios is given by the square root of the portfolio variance. Historical risk and return. At this time, it is beneficial to look at historical risk and return for the three main reasons. Three main asset categories: stock, bonds, and treasury bills. Stock refers to corporate ownership, bonds refers to long-term fixed income securities, and treasury bills refers to short-term government debt securities. Although there is generally no expectations of default on government securities, long-term government bonds price are volatile or risky because of possible future changes in interest rates. In addition, bond holders also face the risk that inflation will reduce the purchasing power of their cash flows. Historical mean return and expected return. Before examining historical data, it is useful to distinguish between the historical mean return and the expected return, which are very different concepts but easy to confuse. Historical return is what was actually earned in the past, whereas expected return is what an investor anticipates to earn in the future. Expected return is the nominal return that would cause the marginal investor to invest in an asset based on the real risk-free interest rate. The expected inflation, or E pi, is the expected risk premium for the risk of the asset. The risk-free interest rate is expected to be positive as compensation for postponed consumption. Similarly, the risk premium is expected to be positive in most cases. The expected inflation rate is generally positive, except when the economy is in a deflationary state and prices are falling, thus expected returns is generally positive. Relationship between the expected returns and the real risk-free interest rates, inflation rates, and risk premiums can be expressed by the following equation. The historical mean return for investment in particular assets, however, is obtained from the actual return that was earned by the investor. Because investment is risky, there is no guarantee that an actual return will be equal to the expected return. In fact, it is very unlikely that two returns are equal for a specific period. being considered. Given a long enough period of time, we can expect that future or expected returns will be equal to the average historical return. Unfortunately, we do not know how long that period is, or 10 years, or 15 years, or 100 years. As a particular matter, we often assume that the historical mean return is an adequate representation of the expected returns. Although this assumption may not be accurate, for example, Exhibit 5 shows that historical equity returns in the last nine years for large U.S. companies' stocks was negative, whereas the expected returns was always positive. Nonetheless, longer term returns were positive and could be consistent with the expected return. Although it is unknown if the historical mean returns accurately represents the expected returns, an assumption that is commonly made. Going forward, to be sure to distinguish between expected returns and historical mean returns, will alert the readers whenever historical returns are used to estimate expected returns. Nominal returns of major U.S. Asset classes are okay. We focus on three major asset classes in Exhibit 5: stocks, bonds, and T-bills. The mean nominal return of U.S. asset classes are reported decides decades by decades since the 1930s. The total of 1926-2008 period is in the last column. All returns are annual geometric mean returns. Large company stock had an overall annual return of 9.6%. During the 83-year period, the return was negative. The return was negative in the 1930s and 2000s, and a positive in all remaining decades. The 1950s and 1990s were the best decades for the large company stocks. Small company stocks fared even better. The nominal return was never negative for any decade, and had been double digits growth in all decades except two, leading to an overall 83-year annual return of 11.7%. Long-term corporate bonds and long-term government bonds earned overall returns of 5.9% and 5.7% respectively. The corporate bond did not have a single negative decade, although government bond records recorded a negative return in 1950s. When stocks were doing extremely well, bonds also held some excellent decades, earning double-digit returns in 1980s and 2000s. Treasury bills did not earn a negative return in any decade. In fact, Treasury bills earned a negative return only in 1938, when the inflation rate was negative 2.78%. Consistently positive returns for Treasury bills do not surprising, because nominal interest rates are almost never negative, and the Treasury bills suffer from little interest rates or inflation risk. Since the Great Depression, there has been no deflation in any decade, although inflation rates were highly negative in 1930, a negative 6.3%, and other years. Conversely, inflation rates were really high in the 1970s and early 1980s, reaching 13.31% in 1979. Inflation rates have fallen since then at a negligible 0.09% in 2008. Overall, the inflation rate was 3% for the past 83-year period. Real returns of major U.S. asset classes, because inflation rates can vary greatly from 10.3% to 13.31% in the last 83 years. Comparisons across various time periods are difficult and misleading using nominal returns. Therefore, it is more effective to rely on real returns. Real returns on stocks, bonds, and T-bills are reported from 1900 in Exhibit 6 to 7. Exhibit 6 shows that $1 would have grown to 834 if invested in stocks, to only 9.30 if invested in bonds, and 2.8 if invested in T-bills. The difference in growth among these three asset categories is huge, although the difference in real returns does not seem that large. 6% per year for equities compared to 2.0% for year of bonds. The difference represents the effect of compounding over 112-year periods. Exhibit 7 reports both the nominal rates of return as well as we discussed earlier, and as shown in the table, geometric mean is never greater than the arithmetic mean. Our analysis of returns focuses on geometric mean because it's more accurate representation of returns for multiple holding periods than the arithmetic mean. We'll observe that the real returns of U.S. stocks are higher than the real returns of U.S. bonds, and that the real returns for bonds are higher than the real returns of U.S. T-bills. Nominal and real returns of asset classes in major countries, along with U.S. returns of major asset classes of the 17 countries, world and the world excluding the U.S. Are also presented in Exhibit 7. Equity returns are weighted by each country's GDP before 1968 because of a lack of reliable market capitalization data. Returns are weighted by a country's market capitalization beginning in 1968. Similarly, bond returns are defined by 17 countries' bonds index except GDP. It used to create the weights because equity market capitalization weighting is inappropriate for bond index, and bond market capitalization were not readily available. The nominal mean returns for the world stock index over the last 109 years was 8.4%, and the bond had a nominal geometric mean rate of 4.8%. The nominal geometric mean returns from the world excluding the U.S. is 7.9%, and the stocks is 4.2% for stocks and 4.2% for bonds. For both stocks and bonds, the U.S. has higher returns than the world excluding the U.S. Similarly, real returns for stocks and bonds in the U.S. are higher than the real returns for the rest of the world. No separate information is available for treasury bills for non-U.S. countries. Risks are major asset classes, risk return of trade-offs, other investment characteristics, and evaluating investment using mean, expected return, and variance. We make two important assumptions. First, we assume that the returns are normally distributed because a normal distribution can be fully characterized by the mean and variance. Second, we assume that the markets are not only informationally efficient, but they are also operationally efficient. To the extent that these assumptions are violated, we need to consider additional investment characteristics. These are discussed below. Distributional characteristics, skewedness, so if it's not a normal distribution, kurtosis, market characteristics, risk aversion, and portfolio selection. As we have seen, stocks, bonds, and T-bills provide different levels of returns and have different levels of risk. Although investment in equities may be appropriate for one investor, another investor may not be inclined to accept the risk that accompanies a share of stock and may prefer to hold more cash. In the same section, we consider investment characteristics of assets and understanding their risk and return. In this section, we consider the characteristics of investors, both individual and institutional, in the attempt to pair the right kind of investors with the right kind of investment. First, we discussed risk aversion and utilitarian theory. Later, we discussed their implications for portfolio selection. The concept of risk aversion. The concept of risk aversion is related to the behavior of individuals under uncertainty. Assume that an individual is offered two alternatives, one where he will get £50 for sure, and the other where he gambles 50% chance and gets £100, the 50% chance that he will get nothing. The expected return in both cases is 50, one with certainty and the other with uncertainty. What will the investor choose? There are three possibilities. An investor chooses to gamble. The investor chooses £50 with certainty, or an investor is indifferent. Let us consider each in turn. However, please understand that this is only one representative example, and a single choice does not determine the risk aversion of an investor. Okay, so that's just an example. The risk tolerance refers to the amount of risk an investor can tolerate to achieve an investment goal. The higher the risk tolerance, the greater the willingness to take risk. Thus, risk tolerance is negatively related to risk aversion. Utilitarian theory and indifference curves. Continuing with our previous example, risk-adverse investor would rank guaranteed outcomes of 50 higher than the uncertain outcome of an expected value of 50. We can say that the utility that an investor or an individual delivers or derives from the guaranteed outcome of £50 is greater than the utility or satisfaction of or happiness he or she derives from the alternative. In general terms, utility is a measure of relative satisfaction from consumption of various goods and services, or in the case of investments, the satisfaction of an investor derives from different portfolios because individuals are different in their preferences. All risk-adverse individuals may not rank investment alternatives in the same manner. Consider the £50 gamble again. What is the guaranteed outcome? Is it only 50? Is it only 40? Some risk advisors, investors might consider 40 inadequate. Others might accept it, and some of them may be indifferent about the uncertain £50 and be certain of the certain £40. Simple implementation of utility theory allows us to quantify the rankings of investment choices by using risk and return. There are several assumptions about individual behaviors that we make in the definition of utility gains in the equation below. We assume that investors are risk adverse. They always prefer more to less, greater return to lesser returns. They are able to rank different portfolios in order to their preferences, and that the ranking are internally consistent. If an individual prefers X to Y or Y to Z, then he or she must prefer X to Z. The property implies that the indifferences curves, see example 11, to some individuals can never touch or intersect. An example of utility function is given below. Whereas U is the utility of the investment, ER is expected return, and variance is the variance of the investment. And in the above equation, A is a measure of the risk aversion, which is measured as a marginal reward that an investor requires to accept additional risk. More adverse investors require greater compensation for accepting additional risk. Thus, A is higher for more risk-adverse individuals. As we mentioned previously, a risk nature investor would maximize return irrespective of risk, and risk-seeking investors would maximize both risk and return. We can draw several conclusions from the utility function. First, utility is unbounded on both sides. It can be highly positive or highly negative. Second, higher returns contributes to higher utility. Third, higher variance reduces the utility, but the reduction in utility gets amplified by the risk aversion coefficient. A, utility can always be increased albeit marginally, by getting higher returns or lower risks. Fourth, utility does not indicate or measure satisfaction and can be useful only in ranking various investments. For example, a portfolio with a utility of 4 is not necessarily 2 times better than a portfolio with a utility of 2. Let us explore the utility function further. The risk aversion coefficient, A, is greater than 0 for the risk-adverse investor, so any increase in risk can reduce his or her utility. The risk aversion coefficient for a risk-neutral investor is 0, and changes in risk do not affect his or her utility. For a risk lover, imagine being called a risk lover. The risk aversion coefficient is negative, creating an inverse situation so that additional risks contributes to an increase in his or her utility. Note that a risk-free asset of standard deviation squared or variance is equal to 0 generates the same utility for all individuals. Indifference curves. The indifference curves plot the combination of risk-return pairs that an investor would accept to maintain a given level of utility. Indifference curves are thus defined in terms of trade-offs between expected rates of return and variance of a rate of return, because an infinite number of combinations of risk and return can generate the same utility for the same investor. Indifference curves are continuous at all points. A set of indifference curves are as plotted in example 11 by definition. All points of any one of these three curves have the same utility. An investor does not care whether he or she is at point A or point B on indifference curve 1. Point A has lower risk and lower returns than point B, but the utility of both points is the same because the higher return at point B is offset by the higher risk, like curve 1. Yeah, so this is just the interpretation of the standard deviation and its expected return between high, moderate, and low utility investments. Different curves in the types of investors. So here are the risk neutrals, the risk lovers, the risk aversions, the moderate risk and high risk aversions, plotted along a graph of the standard deviation versus the expected returns. In the remaining parts of this reading, all investors are assumed to be risk adverse, unless stated otherwise. So risk adverse is, Application of utility theory in portfolio selection. The simplest application of utility theory and risk aversion is to a portfolio of two assets, a risk-free asset and a risky asset. The risk-free asset has 0 risk and a return of RF. The risky asset has a risk of standard deviation I is greater than 0 and an expected return of ERI. Because the risky asset has a risk that is greater than that of the risk-free asset, the expected return from the risky asset will be greater than the returns from the risk-free asset. We can construct a portfolio that has two assets with a portfolio expected return of such an amount and portfolio risk based on this. That's what it looks like. The two asset portfolio is drawn in Exhibit 13 by varying W1 from 0% to 100%. The portfolio standard deviation is on the horizontal axis, and the portfolio return is on the vertical axis. If one of these two assets are available in the economy and the risk asset represents the market, the line in Exhibit 1 is called the capital allocation line. The capital line represents the portfolio available to an investor. The equation for the line can be derived in the above two equations above. We write the second equation as such. The capital, okay. So this is what it looks like before the portfolio standard deviation and the expected returns. Because the equation is linear, the plot of the capital allocation line is a straight line. The line begins with the risk-free asset as the leftmost point with the 0 risk and a risk-free return of RF. At the point the portfolio consists of only the risk-free asset. If 100% is invested in the portfolio of all risky assets, however, we have a return of ERI, which is risk of standard deviation I. We can move further along the line in pursuit of higher returns by borrowing at a risk-free rate of invest. The line plotted in example 13 is comprised of ultimately of unlimited number of risk-return pairs or portfolios. Which one of these portfolios should be chosen by an investor? The answer lies in a combination of indifferent curves for utility theory. With the capital allocation line from portfolio theory, utility theory gives us the utility function or the indifference curves for an individual, as in Exhibit 11. The line plotted in Exhibit 13 is comprised of a limited number of risk-return pairs or portfolios. Okay, so that's what it looks like. The capital allocation line consists of the set of feasible portfolios. Points under the capital allocation line must be attainable but are not preferred by any investor, because the investor can get a higher return for the same risk by moving up the capital allocation line. Points above the capital allocation lines are desirable but not available. With available assets, 3 indifferences curves for the same individual are also shown in Exhibit 14. Curve 1 is above the capital allocation line. Curve 2 is tangent to the line, and curve 3 intersects the line at 2 points. Curve 1 lies completely above the so that's the interpretation. As the illustration, Exhibit 15 shows 2 indifference curves for 2 different investors. Kelly with a risk aversion of coefficient of 2 and Jane with a risk aversion coefficient of 4. The indifference curves for Kelly is the right of the indifference curves for Jane, because Kelly is less risk adverse than Jane and can accept higher amounts of risk. IE has a higher tolerance for risk. Accordingly, their optimal portfolio have different points. K is the optimal portfolio for Kelly, and point J is the optimal portfolio for Jane. In addition, the same returns and slopes of Jane's return curve is higher than Kelly's, suggesting that Jane needs greater incremental returns and compensation for accepting an additional amount of risk compared to Kelly. Portfolio risk. We have seen before the investors are risk adverse and demand a higher return for a riskier investment. There are 4 ways of controlling portfolio risk without affecting returns are valuable. As precursors to management risk, the section explains and analyzes the components of portfolio risk. In particular, it examines and describes how a portfolio consisting of assets with low correlation have the potential of reducing risk without necessarily reducing return. Portfolio of 2 risky assets. The returns and risk of a portfolio of 2 assets were introduced in section 2 of this reading. This section, we briefly review the computation of returns and extend the concept of portfolio risk and its components. Portfolio return: when 2 individual assets are combined in a portfolio, we can compute the portfolio returns as a weighted average of the returns of the 2 assets. Consider asset 1 and 2 and weights of 25% and 75% in the portfolio. If the returns are 20% and 5%, the weighted average return will be as such. So we use this equation to calculate portfolio risk. Portfolio risk or variance measures the amount of uncertainty in portfolio returns. Portfolio variance can be calculated by taking the variance of both sides of the returns equations as below, whereas the COV or the It's calculated as such. The covariance and correlation. The covariance is a formula for portfolio standard deviation, can be expanded as covariance R1, R2 equals as such, where P12 is the correlation between our returns R1 and R2. Although covariance is important, it is difficult to interpret because it is unbounded on both sides. It is easier to understand the correlation coefficient, this P12, which is bounded by provides similar information. Correlation is a measure of the consistency or tendency for two investments to act in similar ways. The correlation coefficient, or P12, can be positive or negative, or range from -1 to +1. Consider the three different values of correlation coefficient as such. The correlation coefficient between two assets determines the effects on portfolio risks when two assets are combined. To see how this works, consider two different values. P12, we will find the portfolio risk is unaffected when the two assets are perfectly correlated, or P12 equals 1. That's when they are perfectly correlated, and they have no correlation when it is at 0, and they have negative correlation when they're at -1. Okay. Sufficient low values of correlation a coefficient can make the portfolio riskless under certain conditions. The first set of terms on the right side of the first equation contains the usual terms for portfolio variance. Because the correlation coefficient is equal to 1, the right side can be written as a perfect square. The third row shows that perfect risk is a weighted average of the risk of individual asset risks. In subsection 4.1.1, the portfolio return was shown always to be a weighted average of returns because both risk and return are just weighted averages of two assets in the portfolio. There is no reduction in risk from P1 or P12 equals 1. All right. Relationship between portfolio risk and return. In previous examples, illustrated the effects of correlation on portfolio risk while keeping the weights in the two assets equal and unchanged. In this section, we consider how a portfolio risk and return vary with different portfolio weights and different correlations. Formulas from computation are in subsection 4.1.1 and 4.1.2. Asset 1 has an annual return of 7% and an annualized risk of 12%, whereas Asset 12 has an annual return of 15% and an annualized risk of 25%. The relationship is tabulated in Exhibit 16 for the two assets of graphically represents in Exhibit 17. Relationship between risk and return. The table shows the portfolio return and risk for correlation coefficient ranging from 1 to -1 and 11 weights ranging from 0 to 100%. The portfolio returns and risk of 15% and 25% respectively. With 0% invested in asset 1 versus 7% and 12% when 100% is invested in asset 1. The portfolio returns varies with weights but is unaffected by the correlation coefficient. Portfolio risk becomes smaller with each successive decrease in the correlation coefficient, with the smallest risk of P12 equals -1. The graph of Exhibit 17 shows the risk-return relationship in the straight line when P12 is equal to 1. As the correlation falls, the risk becomes smaller and smaller as in the table. The curvier nature of a portfolio of assets is recognized in all investment opportunities set except for extremes when P12 equals -1 or 1. Portfolios of many risk assets In the previous section, we discussed how the correlation between two assets can affect the risk of a portfolio, and the smaller the correlation, the lower the risk. The above analysis can be extended to a portfolio with many risk assets, or N. Recall the following equation from section 2.1.2 or 2.1.7 or 2.3.3. The portfolio return and variance to examine how a portfolio with many risk assets works and the ways in which we can reduce the risk of a portfolio. Assume that the portfolio has equal weights. In addition, assume that variance and covariance as the average variance, or the average variance and average covariance. Given equal weights and average variance divided by covariance, we can rewrite the portfolio variance as below. The equation in the second line shows that as n becomes large, the first term on the right side with the denominator of n becomes smaller and smaller, implying that the contributions of one asset's variance to portfolio variance gradually becomes negligible. Correlation and risk diversification. Correlation is a key to in diversification of risk. Notice that the returns of beachwear and DVD rental always go in the opposite direction. If one of them does well, the other does not. Therefore, adding assets that do not behave like other assets in your portfolio is good and can reduce risk. The two companies in above examples have a correlation of -1, a perfect uncorrelation. Even when we expand the portfolio to many assets, correlation among assets remains the primary determinant of portfolio risk. Lower correlation are associated with lower risk. Unfortunately, most assets have high positive correlation. The challenge in diversifying risk is to find assets that have a correlation that is much lower than 1. Historical risk and correlation. When we discuss the asset returns in section 2.4.1, we are careful to distinguish between historical and past returns and expected and future returns, because historical returns may not be a good indicator of future returns. From Exhibit 1, we can see that the risks have typically not varied much from one decade to the next. Expect the risk for bonds that have been much higher in recent decades when compared to earlier decades. Therefore, it is not unreasonable to assume that historical risks can work as a good proxy for future risk. As with risk, correlation are quite stable among assets of the same country. Inter-country correlation, however, can have been on a rise in the last few decades as a result of globalization and liberalization of many economies. A correlation, example 0.9, is considered a high because the assets do not provide much opportunity for diversification of risk, such as correlation that exists among large U.S. companies. On the NSE, the Nasdaq, S&P 500 index, and Dow Jones Industrial Average, correlation between 0.3 are considered attractive for portfolio diversification. Historical covariance among asset classes, correlation among major U.S. Asset classes and international stocks are reported in Exhibit 20 from 1970 to 2008. The highest correlation between U.S. large company stocks and U.S. small company stocks are about 70%, whereas the correlation between U.S. large company stocks and international stocks are approximately 66%. Although there are the highest correlations, they still provide diversification benefits because the correlation are less than 100%. The correlation between international stocks and U.S. small company stocks is lower, and at 49%, the lowest correlation are between the U.S. stocks and bonds, with some correlation being negative, such as between the U.S. small company stocks and U.S. long-term government bonds. Similarly, the correlation between U.S. T-bills and stocks is close to zero, and marginally negative for international stocks. The low correlation between stocks and bonds are attractive for portfolio diversification. Similarly, including international securities and portfolio can also control portfolio risk. It is not surprising that most diversified portfolios of investors contain domestic stocks, domestic bonds, and foreign stocks, foreign bonds, real estate, cash, and other cash classes. Avenues for diversification. The reason for diversification is simple. By constructing a portfolio with assets that do not move together, you create a portfolio that reduces the ups and downs in the short term but continues the growth steady in the long term. Diversification thus makes a portfolio more resilient to gyrations in the financial market. We describe a number of approaches to diversification, some of which have been discussed previously, and some of which might seem too obvious. Diversification, however, is such an important part of investing that it cannot be emphasized enough, especially when we continue to meet and see many investors who are not properly diversified. Diversify with asset classes, diversification with index funds, diversify with among countries, diversify by not owning your employer's stock. Evaluate each asset before adding it to the portfolio. Buy insurance for risky portfolios. Efficient frontiers and investors' optimal portfolios. In this section, we formalize the effect of diversification and expand the set of investments to include all available risky assets in the mean variance framework. The addition of the risk-free asset generates the optimal risky portfolio and the capital allocation line. We could then derive an investor's optimal portfolio by overlaying the capital allocation line with the indifference curves of investors. Investment opportunity sets. If two assets are perfectly correlated, the risk-return opportunity set is represented by a straight line connecting these two assets. The line contains portfolios formed by changing the weight of each asset invested in the portfolio. This correlation was depicted by the straight line in Exhibit 17. If the two assets are not perfectly correlated, the portfolio's risk is less than the weighted average risk of the components. And the portfolios formed from two asset bulges on the left, as shown by curves with the correlation coefficient P less than 1. In Exhibit 17, all the points connecting the two assets are achievable or feasible. The addition of two assets to this portfolio creates more and more portfolios that are either a linear combination of the existing portfolios and a new asset or co. As the number of available assets increase, the number of possible combinations increase rapidly. When all investable assets are considered, and there are hundreds and thousands of them, we can construct an opportunity set of investments. The opportunity set will ordinarily span all points within a frontier because it is also possible to reach every possible point within the curve by judicially creating a portfolio from an investable asset. We begin with individual investable assets and gradually from portfolios that can be plotted to form a curve as shown in Exhibit 21. All points on the curve and points on the right of the curve are attainable by the combination of one or more of the investable assets. The set of points is called the investment opportunity set. Initially, the opportunity set consists of domestic assets, overlays, and labeled as such in Exhibit 12 or 21. Investment opportunity set Addition of asset classes. Exhibit 21 shows the effect of adding a new asset class, such as international asset, as long as new asset classes is not the investment opportunity set with international assets dominates the opportunity set that includes only domestic assets. Adding other asset classes will have the same impact on our opportunity set. Thus, we should continue to add asset classes until they do not further improve the risk-return trade-off. The benefit of diversification can be fully captured. In the discussion that follows in this section, we will assume that all investable assets available to an investor are included in the investment opportunity set, and no special attention needs to be paid to new asset classes or new investment opportunities. Minimal variance portfolios, the investment opportunity set consisting of all available investable sets, is shown in Exhibit 22. There are a large number of portfolios available for investment, but we must choose a single optimal portfolio. In this subsection, we begin the selection process by narrowing the choices of fewer portfolios. Minimum variance frontier. Risk-free asset and many risky assets. Until now, we have only considered risky assets in which the returns is risky or uncertain. Most investors, however, have access to risk-free asset, most notably from securities issued by the government. The addition of risk-free assets until makes the investment opportunity set much richer than an investment opportunity set consisting only of risky assets. All portfolios on the efficient frontier are candidates for being combined with the risk-free asset. Two combinations are shown in Exhibit 23, one being the risk-free asset and efficient portfolio A, and the other being the risk-free asset and efficient portfolio P. Comparing capital allocation lines in A and capital allocations in line P reveals that there is a point in the covariance of P with a higher returns and the sum risk for point on in other words, the portfolios on CALP dominates the portfolio on CALA. Therefore, an investor will choose CALP over CALA. We would like to move further northwest to achieve even better portfolios. None of these portfolios, however, is attained because they're above the efficient frontier. What about other points on the efficient frontier? For example, point X on the efficient frontier and has the highest return of all risky portfolios for the risk. However, point Y on Cal point, achievable by leveraging point P, as seen in section 3.3, lies above point X and has the same risk but higher return. In the same way, we can observe that not only does Cal P dominate Cal A, but also dominates the efficient frontier of risky assets. The capital allocation line connects the optimal risky portfolio and the risk-free asset. All optimal investors' portfolios must be in line with this. Each investor's optimal portfolio on the Cal P is determined by the second step, considering each individual asset risk preference using indifference curves determines the investor's allocation to the risk-free asset, lending and to the optimal risky portfolio. Portfolios beyond the optimal risky portfolio are obtained by borrowing at the risk-free rate. Therefore, the individual investor's risk preference determines the amount of financing optimal investor portfolio, the CalP in Exhibit 23-25 contains the best possible portfolio available to investors. Each of these portfolios is a linear combination of the risk-free asset and the optimal risky portfolio. Among the available portfolios, the selection of each investor's optimal portfolio depends on the risk preference of the investor. In Section 3, we discuss that the individual investor's risk preference are incorporated into their indifference curves. Those can be used to select the optimal portfolio. Exhibit 25 shows an indifference curve that is tangent to the capital allocation line. CalP indifference curves with higher utility than this one lies above the capital allocation line, so their portfolios are not achievable. Indifference curves that lie below this one are not preferred because they have lower utility. Thus, optimal portfolios for the investor with this indifference curves in portfolio C and CalP, which is tangent to the indifference curves. Investor preference and optimal portfolios. The location of the optimal investor portfolio depends on the investor's risk preferences. A high-risk adverse investor may invest in large proportions, even 100% of his or her assets in a risk-free asset. The optimal portfolio is, in this investor's case, will be allocated close to the y-axis. A less risk-adverse investor, however, may invest in a large portion of his or her wealth in the optimal risky assets. The optimal portfolio in this investor's case will lie closer to point P. In Exhibit 25, some less risk-adverse investors may wish to accept even more risk because of the chance of higher returns. Such an investor may borrow money to invest more in the risky portfolios. If the investor borrows 25% of his or her wealth, he or she can invest 125% in the optimal risky portfolio. The optimal investor portfolio for such investor will lie on the right side of point P on a capital allocation line. Thus, moving from the risk-free asset along the capital allocation line, we encounter investors who are willing to accept more risk at point P. The investor is 100% invested in an optimal risky portfolio beyond point P. The investor accepts even more risk by borrowing money and investing in the optimal risky portfolio. Note that we are able to accommodate all types of investors with just two portfolios: the risk-free asset, and the optimal risk portfolio. Exhibit 25 is also an illustration of the two found separation theorem. Portfolio 5 is the optimal risky portfolio that selects without regard to investors' preference. The optimal investment portfolio is selected on the capital allocation line, but by underlying the indifference curves that incorporates investor preferences. This reading provides a description on computation of investment characteristics such as risk and return. These investors use in evaluating assets for investment. This was followed by a section about portfolio construction, selecting the optimal risky portfolio, and an underlying understanding of risk aversion and the indifference curves. Finally, the tendency point of the indifference curves with the capital allocation line allows identification of the optimal investor portfolio. Key concepts covered in this reading are included below. A holding period return is the most appropriate for a single predefined holding period. Multi-period returns can be aggregated by in many ways. Each returns computed has special applications for evaluating investments. Risk adverse investors make investment decisions based on the risk return trade-off, maximizing returns for the same risk, minimizing risk for the same returns. They may be concerned, however, by deviations from a normal return distribution and from assumptions of financial markets operational efficiency. Investors are risk adverse. The historical data confirms that financial market price assets for risk adverse investors. The risk of two asset portfolios is dependent on the proportions of each asset, their standard deviation, and their correlation or covariance between the assets' returns. As the member of asset is in the portfolio increases, the correlation among asset risks becomes a more important determinant of portfolio risk. Combining assets with low correlation conduces a portfolio risk. The two funds separation theory allows us to separate distinct decisions, making two steps. The first step, the optimal risky portfolio, and the capital allocation line are identical, which are the same for all investors. In the second step, investor risk preferences enable us to find a unique optimal investor portfolio for each investor. The addition of risk-free assets creates portfolios that are dominant to portfolios of risky assets. In all cases, except the optimal risky portfolio. By successfully understanding the content of this reading, you should be comfortable calculating an investor's optimal portfolio given the investor's risk preference and universe of investable assets available. Okay, so that is reading 39. Ooh, we're done with reading 39. What a spicy chapter. I feel a little bit sick today. That's why my voice may be sounding weird. But yeah, we finished reading 39. We'll be going into reading 40 next time, about part 2 of portfolio risk and return. I hope to see you guys there, and I hope my readings have been helpful. If you wish to access the show notes are linked below. To my Amazon link, you can go buy my show notes, and it will be much helpful in your study for the CFA Level 1 program curriculum. So thank you for coming by, and hope to see you guys next time. Goodbye.